Good morning, Contrarians. Sign up to get the full briefing at contrarianpod.substack.com. So 3 days of trading in September and 3 days of losses. And it looks like this inflation boogeyman is still hanging around. The yields on the short-term bonds, the 2-year, certainly bear this out, as these spiked up again above 5% yesterday. Important psychological barrier. As I mentioned at the top, they've come back down a bit, down to 4.99%, but still a lot higher than they were last week. So that certainly speaks to the concerns of investors about inflation. And with inflation comes higher for longer Fed. Now, futures traders are still not pricing in any movement at the next Fed meeting, which concludes September 20th, so a little less than 2 weeks from today. 93% are still expecting no change to the key policy rate. In light of the Fed comments, the Fed speaker comments we've had, that makes sense. But if you look ahead to the subsequent meeting, which concludes November 1st, expectations have started to creep up a little bit. We're now looking at a 44% expectation of a rate hike of 25 basis points. That's up from 37% a week ago. One would think that's still pretty low, given what's been going on in bond markets, given these renewed concerns about inflation. We don't get another inflation data point until next week. The CPI, this makes the CPI on Wednesday loom very large indeed. And it's kind of hard to see how the prevailing mood will change before then.